today's unemployment report, today's jobs non-farm payroll number will be the most backward-looking, lagged of all economic data. That is something that you learn your first day at a central bank, is that the most lagging of all indicators is that jobs report. What we've seen in jobless claims, they came off their lows of 201,000. We were supposed to see a big bounce back. In yesterday's release, we didn't. That was indicative. And what we saw in the Challenger data was also much more than just a General Motors aberration. We've seen the monthly average layoffs increase from an average of 35,000 a month last year to the last 4 months. We're running at 55,000 a month, up 28% year over year. Looking forward, I think, is what investors need to be concerned with, and that's what's got the Fed looking to pause.
So if you are looking forward, let's take your mold there and say, what are you looking at? If you were still in a role to advise the Fed, which you have been in the past, if you were there, what exactly would you be looking at that tells you either interest rates should go higher or should be paused?
Well, I think the most important thing that you need to look at is the most leading of all indicators. That would be the housing market. If you look at the most recent data that we've seen, pending home sales, that's a forward-looking indicator, 10 of the last 11 months, year-over-year declines. This is not a 1 or 2 month off type data. We know that since early spring that housing has been slowing. We know that the automobile sector is coming into some trouble. Obviously, Mary Barra broadcast that by laying off a third of her entire North American workforce. So these are things that should indicate to the Fed that they don't need to be looking backwards at this morning's unemployment rate, but they need to be looking forward at things that lead the economy into and out of recession.
So as we take a look at this jobs number today, we often focus on the headline number because it is a headline number. We've talked about things like average hourly earnings. We've talked about things like the average work week. What nuance within jobs catches your attention the most?
I'm going to go back to my first days at the Fed again. And my mentor there told me that the thing that you should always pay the most attention to is the back months revisions. If you start to see back-to-back months of downward or upward revisions, that should tell you that the economy is at an inflection point. And so that's what I pay attention to the most closely. Yesterday's unit labor cost report was very telling. We went from a 3% rate to an 0.9% rate in very short order due to backward revisions to prior quarters. So we're seeing a marked deceleration that tells us maybe there was a lot of panic buying ahead of the potential levying of higher tariffs. Maybe we're going to see that back off. One of the reasons that popped onto Challenger's data yesterday for laying off employees was reduced demand. That was a very blunt way of saying we don't have enough demand for our products. So I would be looking at backwards revisions to prior months.
Speaking of reduced demand and lags, we've talked a lot about the yield curve.
Oh yes.
Certain parts are inverted, other parts are flattening. As a former policymaker, how much does the yield curve play into your mind? Does it signal perhaps that 6, 9, 12, 24-month lag on a recession that could be coming at some point? Or should we be paying as much attention to it as we are right now?
You know, I was actually speaking to Richard Fisher about this just yesterday, and he and I are both in agreement that because the last recession, the Great Recession, was also a balance sheet recession, that we need to actually look a bit further back in time. The last balance sheet recession that this country suffered was the Great Depression. The 6 recessions that followed were not preceded by an inverted yield curve. Moreover, because valuations are where they are in stocks and bonds, we need to look to the 1999 episode when the inversion was quickly followed by recession, as opposed to the 24 months of runway that we had after 2005 before we slipped into recession in 2007. So as a policymaker, am I paying attention to it? Yes. Is it the end-all, be-all? Not necessarily. I don't think we necessarily have to invert to go into recession this time around.